Hello everyone, I am Pratap here. We are at lesson 5 examples related to how to trade by using supply and demand zone fundamentals. And before you look into this example session, please note we are providing complete free training on supply demand zone price action. And this lesson is having dependency on the earlier lessons. So you need to complete the earlier lessons before you get into lesson 5. You can access all the earlier lessons at our NeoStock YouTube channel. To access all the earlier lessons, you just click on the playlist and you will be getting different playlists, and you should be focusing on two important playlists. One is Supply Demand Zone Price Action course. Here you have all the training lessons are available. And the new playlist is examples related to supply demand zone price action course. Now I am recording lesson 5 examples video. So that's why you should complete the earlier videos. For that, click on view full playlist in supply demand zone price action course. Also later you can also examples also click on view full playlist. Here you have all the training lessons are available up to lesson 30. You just scroll down to the bottom of the page. Here starting from lesson 1.1, all the training lessons are placed in an order. So complete lesson 1.1 and then go to examples playlist, complete the lesson 1.1 examples. Similarly lesson 1.2, after that examples playlist, examples video. Like that you complete up to lesson 5. After that you get into lesson 5 examples video. And one more thing, before you get into the examples video, I also request you complete lesson 9.1 practical corporate actions, how to draw demand and supply zones in trading view. I have explained to one important tool and learn that tool. That tool will explain how to draw the demand zone and supply zone in trading view. Because I don't want to repeat the same thing that you already learned in lesson 1.1. That's why before you get into lesson 5 examples, please complete lesson 9.1 practicals video. I have also explained corporate actions. They are useful only for the equity charts. And this corporate actions is not required for Forex trading and also not required for crypto trading, not required for commodity trading, because there won't be any corporate actions like dividend, split, bonus. Such kind of corporate actions are not available. But if you are practicing on the equity charts, you must understand the importance of corporate actions. That lesson also you please complete. That part of the video also you please complete before you get into lesson 5 examples video. Hope I made it very clear. Okay, now I am going to examples, but before getting into the examples, let me quickly summarize what you learned in lesson 5. You have learned both demand and supply zones are having proximal line and distal line. This is what you learned. What is proximal line? What is distal line? If you want to understand in detail, please go to lesson 5 training video. First you complete that. Here I am only giving you the summary, what you learned in lesson 5. And also proximal line can be used for defining either entry or target for your trades. And also distal line can be used for defining the stop loss in your trade. And you also learned 3 important proximal line placement rules for both demand zone as well as supply zone. And for this demand zone, proximal placement line could be either highest wick, that is called type 1 proximal line, and highest body of the base candles, that is called type 2 proximal line, and third one is the lowest body of the base candles, that is called type 3 proximal line. That is what you learned in lesson 5. And also for supply zone, You also learned proximal line can be placed at lowest wick of the base candles, that is type 1 proximal line, or lowest body of the base candles, that is called type 2 proximal line, and highest body of the base candles, that is called type 3 proximal line. These are the rules in detail with examples I explained in lesson 5 video, training video. And also you also learned a very important concept, risk reward. You already learned risk is nothing but potential loss. If your analysis goes wrong, how much loss you are going to get, that is what risk will be telling you. How do you calculate risk? That is, you already learned absolute value of entry minus stop loss. It gives you the risk. And reward. Reward is nothing but the potential profit you are going to get if your analysis goes in your favor or your analysis is accurate. And reward will be calculated based on absolute value of entry minus target. That means before taking the trade itself, the supply demand zone price action system is telling you, in case analysis goes, how much loss you are going to get. If your analysis is in your favor, how much profit you are going to get, you know well in advance. If you can't bear the loss, what you do? You don't take the trade, you simply reject the trade. If the loss is very minimal, even any case, due to any reason, if your analysis goes wrong, still the amount of money you are going to lose, you can able to bear. If you know that, you will plan trade in that particular zone. That is the beauty of supply demand zone price action. That's why the risk management system is very important. Many people, without using this risk management, they are trading in the stock market and then they are getting huge losses if their analysis goes wrong. But that won't happen in our case, because before planning the trade itself or before taking the trade itself, you know how much money you are going to lose in case if your analysis goes wrong. If you can't bear that much loss, simply you reject the trade. That is the beauty of this concept. The decision making is there in your hands. So let us look into the examples related to cryptocurrency, commodities, Forex and different indices. And equity related examples, I gave several examples from lesson 9 onwards. That's why I am not focusing much on equity related examples in these examples video so far. Okay, first let us take Bitcoin. And how to draw. First I will tell you how to draw demand and supply zones by using proximal line placement rules. Okay, see here, you have a drop candle, you have 3 base candles, maybe this is also looking like a large candle, and also maybe body is greater than maybe 30% or 40%. Maybe you may consider this as a leg out. Some of you may not convince. If you feel this is the base candle, then you draw a very big line. But I am convinced, okay, this could be a large candle because the next candle is also a large candle. That way I convinced. I consider this drop, 3 base candles, drop and drop follow through candles. What is this follow through candles? You will learn in the upcoming lessons. That's why time being, just I introduce the word. Later on you will learn. Okay, in lesson 9, in lesson 9.1 video, I have explained how to draw demand and supply zones by using the tool price range tool. Where is it? Yeah, in the bottom here you have a price range tool. This price range rule, I created a shortcut here. I explained how to create the shortcut also in lesson 9.1 video. That's why I am requesting all you people, first you complete lesson 9.1. How to, using price range rule, how you can draw demand zone and supply zone, I clearly explained. Okay. The high of this particular, this all the base candles, and the low of this all the base candles. This is the high and this is the low. Between, using price range tool, I am drawing the supply zone. So here I am clicking this price range tool from here. Now I am drawing, this is a supply zone. Okay, this is the high of the, this is called supply zone, and this is the high of the zone, this value. You can look into the coordinates. 119,336 is the high of the zone. 116856 is the low of the zone. And this is called supply zone's proximal line, and this is called supply zone's distal line. What kind of zone I have drawn? Wick to wick I have drawn. Between higher wick of the base candles and lower wick of the base candles. See here, prices moved in a balanced way in this area. Now all of a sudden imbalance took place. That means supply exceeds the demand. That's why we have drawn this supply zone. We have a drop, 3 base candles, and a drop candle and another drop candle. Some considerable amount of price is down, and here in a balanced way we have a supply zone. We know that here we have institutional pending sell orders will be available. Supply zone always contains institutional pending sell orders. Pending means unfilled orders. Unfilled means they are not yet executed. When prices are going down, I am talking about in this candle or in the next candle. Here by this time this zone is having institutional unfilled, that means not executed sell orders. So that next time prices enter into the zone, these unfilled, that means not executed sell orders again pushes the prices down. See, that is what happened. Okay, this concept I already explained in lesson 2 examples videos. Okay, but what you have to learn in this video? What is proximal line, what is distal line, and proximal line placement rules. After that you will be seeing risk and reward. But before that, let us focus on these rules. Proximal placement lines. We have 3 rules. What is the first rule? Lowest wick of the base candles for the supply zone. See, you have 3 base candles. What is the lowest wick? This is the lowest wick. And highest wick is distal line. So distal line placement rules, only one rule. For supply zone, highest wick. That's it. That is the distal line. But proximal line, we have 3 rules. First rule is lowest wick. And the second rule is lowest body of these base candles. Where is the lowest body? Here. And the third rule is highest body. Where is the highest body? Here. Body high here. This is how you can draw the zone. If you draw the zones, what are the advantages and disadvantages? That also I will explain. Okay, first advantage is when you draw wick to wick, there are higher chances prices will be reaching up to the lowest wick of this. That means this is the edge of the zone, low of the zone. In the next time prices reach, definitely there are higher chances price will just touch the zone. If the institutional pending orders are very, very strong here, immediately without letting the prices further move up, they will be pushing the prices down. So that means at least we have higher chances of getting a trade. Trade execution is important. See, you identified a zone. but whatever you marked, prices did not come onto that marked area. That means, are you missing the trade? Yes. Something little below marked area prices reached, and then from there again they started reversed. That means you will be missing the trade. So if you draw wick to wick, that is type 1 proximal line, there are less chances of missing the trade. Chances are less. At least many times your trades will be executed if you draw wick to wick. That is the advantage. Then what is the disadvantage? The disadvantage is your risk will be increased. What is risk? Risk means this proximal line minus distal line, absolute value. So here risk is equal to absolute value of proximal line is our entry. Remember, proximal line is our entry. Proximal line, see the second point, proximal line can be used for defining the entry. Or target also. The opposite side zone target, whichever we are planning the trade, that is the entry. So that's why proximal line can be used as either entry or target. If demand zone is the entry, supply zone is the target, proximal line. Similarly, if supply zone is your entry, proximal line, then demand zone proximal line is our target. That way you should understand. That's why in a single statement I defined proximal line can be used as either entry or target depending on demand or supply zones. Okay. Next, what did you learn? Distal line can be used as defining the stop loss. So that's why risk will be calculated as absolute value of your entry and stop loss. Suppose you are planning your trade in the supply zone. Your entry is your proximal line. Your target is your distal line. Your stop loss is distal line. And risk is your entry minus stop loss. Where is your entry here? The low of this zone. Where is the stop loss? The high of this zone. So let us calculate your risk. Minus because Bitcoin is in US dollars. So 2,480 US dollars is the risk for this particular zone. So what is the disadvantage if you draw wick to wick? The risk will be increasing more. But advantage, higher chances of getting the trade. Okay, this is a type 1 proximal. Next, type 2 proximal. Instead of type 1, I want to draw type 2 proximal. What is type 2 proximal? The lowest wick of the supply zone. Where is the lowest wick? This candle low and this candle close, or this candle, actually candle body low, this candle body low, this candle body low. We have 3 candles. Among these 3 candles, whichever the one is having lowest value. So this candle is having the lowest value. So you are drawing the zone up to here. Now what is the advantage? The advantage is your risk is minimized. See, earlier risk $2,480. Now I will calculate type 2 proximal risk. This is the stop loss distal line value minus your proximal is your type 2 proximal. This is your type 2 proximal value. See, 1,885 rupees. 85 US dollars. See, earlier risk was 2,480 US dollars is our risk. Now the risk is reduced to 1,885 US dollars. See how the risk is reduced. This is the advantage. Of course, another advantage is also there. Our reward also will be improved. That we will see later. But what is the disadvantage? Disadvantage is sometimes if prices are reversed from the type 1 proximal, that is low of this base candles, if they are reversed, you will be missing the trade. But in this case, we are lucky. It just touched the type 2 proximal and then prices are reversed. Just imagine what would have happened a little below the type 2 proximal. This is type 2 proximal. That is lowest wick of the base candles. Just a little below, if the prices are reversed, you would have missed a very good trade. Okay. But this is the ideal scenario. Many times people use the type 2 proximal. Many times. This is the ideal scenario. There are other rules also there. They are the advanced concepts you will be learning. In the second phase of the examples videos, you will be learning. Now at present, until lesson 10, it is first phase of the training course. Advanced concepts you will be learning in phase 2 training, that is from lesson 11 onwards. At that time, you will be learning other techniques for identifying the entries. But this is the standard procedure, type 1 or type 2 or type 3. Okay, type 2 is the ideal scenario. Many people will use because they have advantage is they have a better managed risk at the same time. Getting prices up to type 2 proximal may happen in majority of the scenario. I will not say all the scenario, but at least better scenarios. But compare it to the type 3 proximal, this is the best situation. What is type 3 proximal? Type 3 proximal is highest body of the base candle. Where is the highest body among all the three? The first candle is having highest body. So let us draw the zone. If you draw the zone like this, what is the advantage? Our risk is minimized. See, now let us see what is the risk. This is the distal line, that is stop loss value. Let me open another calculator, third one. So stop loss means distal line minus proximal line. Here which proximal you are using? Type 3 proximal. This is the type 3 proximal value. I am copying the value. You get your risk is only $943 US. Now you compare all the three. See, this is the type 1 proximal. You have $2,480 US risk. Type 2 proximal, you have $1,885 risk. And type 3 proximal, you have only $943 risk. That means if you are using type 1 and if your analysis goes wrong, you will be losing $2,480 for one Bitcoin. Suppose if you are using type 2 proximal and if your analysis goes wrong, you will be losing $1,885 for one Bitcoin. Similarly, if you are using type 3 proximal and if your analysis goes wrong and your stop loss is hit, your distal line, then you will be getting $943 as a loss. So among three, which is the best? You feel third one is the best, right? But the problem with the third one is many times prices may not be reaching up to type 3 proximal level. Before itself prices will be moving down. That means majority of the times you will be missing the trade. When you have to go to type 3 proximal, if you really can't bear the risk of type 1 and type 2 entries, there is no question you can't take a trade, you can't bear that much risk in case if your analysis goes wrong. At that time, you will go for type 3. If your luck is there, prices will enter, and if your analysis is perfect, prices will be moving down. That way you will be getting profit. But rare scenarios only happening like that. Ideal scenario is a type 2 proximal. What is type 2 proximal? Lowest body. Type 1, lowest wick. This is the type 1, lowest wick. And the type 2, lowest body. This is the type 2. Imagine you would have planned your trade here. Type 2 here. This is your entry. This is your entry. And this is your stop loss. Your stop loss is 11936. Sorry, 119336 US dollars. At the price reach, just crosses this value, you will exit the trade. And you book loss. And what is your entry here? 117451 US dollars. At the time prices enter, you take the trade. This is how you are planning type 2 proximal. Then what about your target? Target is your demand zone. Where is the demand zone here? You have a drop, you have 1, 2, 3, 4 base candles, and you have a rally candle, and next very good again, another rally candle. So this is a good area. Generally supply zone will be represented with red color, demand zone will be represented with green color. I already created shortcuts. How to create shortcuts I already explained in lesson 9.1 video. That's why I'm recommending all you people complete lesson 9.1, then get into this video. That's why I'm not explaining how I am drawing these zones. Already explained in lesson 9.1 video. Okay. So here you have a demand zone. Okay. What is the proximal, what is the distal line rule? Distal line in drop base rally. In drop base rally, the lowest wick of the drop candles, base candles, and rally candle. That is the, here you have to. So that way we have drawn. In rally base rally, between highest wick and lowest wick of the zones you will be drawing in rally base rally. In drop base rally, the rules are lowest wick of the drop candle, lowest wick of the base candles, lowest wick of the leg out candle. That means rally candle. Lowest wick of drop, that is leg in, lowest wick of base candles, lowest wick of rally, that is a leg out candle. Among these three candles, whichever is having the lowest value, that will be your distal line. So that's why the lowest wick of the leg in is the distal line. Many times highest wick of the demand zone you will be using as a target. Some situations you may use a type 2 also, but always a target point of view, type 1 is the safest approach. Target point of view. Entry point of view, type 2 proximal is the ideal scenario. But risk management point of view, you may go to type 3. Or if you have fear that you may miss the trade, you don't want to. Because even type 1 also risk is, you can accept. In that case, you draw wick to wick. Like this, wick to wick you draw. If your risk is acceptable. Otherwise, depending on the risk, you will be selecting either type 2 proximal or type 3 proximal. One of them you will be using. If anybody would have selected type 3 proximal in this analysis, they might have missed a very good trade. And those who selected type 2 proximal or type 1 proximal, they would have got the trade in this Bitcoin trade. Short trade. This is the short trade. Supply zone trade is always short trade. Demand zone trade is a long trade. And supply zone trade, demand zone type 1 proximal is the target. And in demand zone trade, that is long trade, supply zone type 1 proximal could be your target. This is how you will be identifying entry and target. That's why I specified In the presentation, proximal line can be used for defining either entry or target. If it is demand zone, it is the entry. Target zone, supply zone, it is the target. Similarly, if it is the supply zone is the entry, then demand zone is the target. This is what you should understand. That means prices are moving between demand and supply zones. One is the entry and another one is the target. Okay, fine. Okay, this is your target. This is your entry. Did you get the entry? Yes. When we got the entry on 22nd August 2025. It gave you the entry. After that, prices came down a little and closed, and next day onwards, prices are moving down, and 25th August, it reached the target. Okay, fine. How much profit you would have got? What is the profit? Profit means reward. Loss means risk. We already calculated type 2. This is the second one. This is the risk we are handling. And what is the reward? Reward is your proximal, your entry minus and the proximal line of demand zone. That is your target value. Target value is, this is the one, the high of this particular zone. What is the high of this zone? 109711. This is the target. And this is the entry. What is the entry? 117451 is our entry. This is the entry minus your target. High of these base candles, that is the type 1 proximal, is your target for the demand zone. That is 109711. That means you would have got $7,740 as a profit if you would have purchased one short trade at this type 2 proximal line of the supply zone. On 22nd August and 25th August, you would have booked the profit in just 3 trading sessions or maybe 4 trading sessions. First trading session is the entry, second, third and fourth trading session is reached your target. In just 4 trading sessions, you would have got 7,740 rupees. Sorry, 40 US dollars. Rupees is Indian currency. Sorry for the mistake. 7,740 US dollars. You would have got the profit. This is your reward. And what is the risk? This is your risk. If your analysis would have gone wrong, you would have got 1,885 US dollars as a loss. But when you get the profit, 7,740 US dollars as a profit. Okay, what is the RR, risk reward? That is called RR is risk reward. That is very, very important. Here I have explained the reward equals to risk equals to absolute value of entry minus stop loss. Reward equals to absolute value of entry minus target. Both we calculated. What is risk reward? Risk divided by reward. That is called as RR. Risk divided by reward. Okay, this is our risk and this is our reward. Okay, now I will calculate the how much RR I would have got. For 1:1, 7740 divided by 1885. You would have got 1:4.1 reward. You would have got 1:4.1 reward. For one risk, 4 times reward you are getting, or 4.1 times. Or round figure I am saying, for one risk, 4 times reward you would have got in this trade. Excellent, right? Yes. This is how you calculate risk reward. For every one risk, how many times reward you are getting. That's why always we represent risk reward as a 1:2 or 1:3 or 1:4 or 1:5 or 1:2.5 or 1:3.5 or 1:7.1. In this case, you see 1:4.1. So this is the excellent trade. See what we identified here? We identified the entry. We identified the stop loss as the distal line. And also we identified the target. From entry to target, how much risk reward you have for every one risk. Let us assume this entire thing is one time risk. And you are getting 4 times reward you are getting. That means 4 times value of this much. Whatever the value is there in the supply zone. That much value 4 times you are getting. That is what reward. See the difference of this supply zone. From entry to stop loss, whatever the value. Earlier we got some 943 or something we calculated, right? So into 4 times we are getting the reward. That is the beauty of supply demand zone price action. Whenever we get the losses are minimal. Whenever we get profits are like 3 times profit or 4 times profit. At least 1:3 minimum risk reward is not there. We won't accept the trade. Maybe experienced people may accept 1:2.5 risk reward they accept. For every one risk, at least 2.5 times reward is required. That is for experienced people, highly experienced people. But you people are learning supply demand zone concepts. Up to people having 3 years or 4 years supply demand zone experience from 0 years to up to 4 years, 3 to 4 years. Don't go to 1:2.5 reward. Don't go. Go for only minimum 1:3. Minimum 1:3. Maximum can be anything. If minimum 1:3 is there, then you accept the trade. Otherwise, don't accept the trade. Okay, now prices reached here. This is a short trade. Those who wants to plan for a long trade, maybe you can plan type 2 proximal. Why type 2 proximal? That is the ideal scenario. Okay, for demand zone, long trades. Okay, earlier we discussed about short trade, supply zone. Suppose demand zone is our entry. Then how you will be planning? First of all, we have drawn a zone. And how you can plan the trade? 3 ways. Type 1 proximal, type 2 proximal, type 3 proximal. What is type 1 proximal in demand zone? Highest wick of the base candles. That is what you have seen here. For demand zone, the proximal line can be placed highest wick of the base candles or highest body of the base candles. This is type 2. Or lowest body of the base candles. This is type 3 proximal. So now I have drawn type 1 proximal, highest wick of the base candles. Okay, if I want to go to type 2, among all the 4 base candles, which one is having highest body of the base candles? So here we have highest body of the base candles. Suppose if you feel the risk is also very high, you can plan lowest body of the base candles. What is the lowest body? This is. See, now risk is at the least level. But lowest body, many times trades might be missing. Rarely you get a successful trade. Suppose those who planned lowest wick of this base candle, also you would have got the trade here. And then prices were started moving up. Those who planned type 3 proximal, Here people would have missed the trade. Here people would have got the trade. See here. Those who planned type 2 proximal, they might have missed the trade. Sorry, type 3 proximal. This is type 3 proximal. They might have missed short trade here, but they might have got long trade here. But remember, these scenarios are rarely executed. That's why those who got type 3, they are the lucky people. Why I'm saying lucky people? Because their risk is very, very small. They would have got a very huge reward. Got it? Okay. Okay, now let me tell you important thing. If anybody would have, what is our target, earlier planned target? This is the one. Wick to wick, mostly target will be wick to wick. Now this is our trade and this is our target. See, once prices this is our target. Please, this is a very important point. Everybody should concentrate here. Many times I tell people expect recommendations. Recommendations fail many times. You should learn the subject. Why I am teaching subject? If you learn the subject, you get better profits. If you are depending on the recommendations, many times you get losses. Why you get many times losses? This is a classic example. So let me tell you. When you planned our trade, let us assume you planned our trade. You got the trade, right? So you got the entry. Type 2 entry you got in this candle. You got the trade here in this candle. This is our target. See, after that what happened? Prices moved and one more supply zone is created here. Did you notice? This is one more supply zone is created. When already you took the trade in this candle, when one more supply zone is created, immediately your target will be changed to the new supply. You already took the trade. At the time of you took the trade, this was your target. Because this new supply zone is created, there are two possibilities. Because of this supply zone, this entire demand zone will be gone. All the orders consumed and it will go down. Luckily, you see, almost consumed. It went up to this stop loss value. Just touched and again it moved. That means our stop loss is not executed. But this time, does it reach the supply zone? No. The newly created supply zone is created. People who give you recommendation, they would have told you this is your target. But because of changes in the market, because market is dynamic, you never know when market changes. When market changes, earlier recommendations will change. That's what your target is changed. You never know your target is changed because at the time of getting recommendation, this was your target. You are already in the trade. Because of this new target, whether it is a small profit or big profit, you have to exit your trade here. Because you got a new target. Why we got new target? Because market is dynamic. Everybody should accept this point. Market is dynamic. After we get the recommendation, market may change. Because market may change, you got a small profit. Getting small profit is better. Getting stop loss is better. Now you tell me. Definitely getting small profit is better than getting loss, right? And people who got the recommendations, they never know about the changes that happened in the dynamic market. You are still thinking prices will be reaching here. It may reach or it may not reach. Who knows? We never know. But new target it is reached. If you are still keeping your trade, maybe after some time again prices will come down. And finally it will hit your stop loss. Instead of booking this small profit, you booked with loss. And people who are having knowledge in supply demand zone, they would have booked with this small profit. Something is better than nothing, right? That is what we got, at least something, small profit. And more, our small profit is always far, far better than getting loss. Let's imagine after few days market came down and it hit the stop loss. You would have got the loss, especially those who are following recommendations. But those who land supply demand zones, they identified the new change in the market and booked the profit. See the difference what would have happened. Okay, first let us calculate the loss. This is the proximal line value minus this is the distal line value. This is type 1 proximal line, type 2 proximal value. This is type 2 proximal value minus distal line. If you get a loss, 1,928 US dollars loss you will get in case if your analysis goes in this route. Okay, because you all land supply demand zones. Because you land supply demand zones, we recognized this new supply zone. Because of the new supply zone, earlier analysis is gone. That is invalid. Now, because of the new supply zone, if prices reaches to new supply zone, maybe even if it is small loss, even if it is not minimum 1:3 RR, because already you are in the trade. At the time of planning, 1:3 RR you have. But once you took the trade, markets changed. Because of that, RR is changed. You can't do anything because you already took the trade. Whether RR is there or not, you have to exit if it reaches this supply zone, the new supply zone. Okay, what is the new supply zone value here? The new supply zone value is 111273. This is our target. Oh. This is our target value. And what is the entry here? Earlier we took at 109,231. You would have got 2,042 US dollars profit. You got at least 1:1 RR you achieved. But okay, already you are in the trade, you don't mind. At the time of planning, you planned 1:3 only. Because market is dynamic, because of the dynamic market, instead of getting 3 times profit or 4 times profit, you got only 1 time profit. That is good. See, this is the difference between the person who took recommendations, you would have got 1,928 US dollars loss. This is the loss. This is the risk. Suppose after next few days market turned down and again it hit the stop loss. This is the loss you would be getting. But because you know the subject and you have identified this new supply zone, the moment prices reached the new supply zone target, now you are not aiming for the old analysis. You are aiming for the new analysis because you are already in the trade. Whatever the profit, whether it is small or negligible profit or maybe that is good profit, whatever it is, you will book the profit. That way you would have got 2,042 US dollars profit you would have got. Within how many trading sessions? This is the first trading session. You got the entry. Here. This is the first trading session we got the entry. After entry, some dynamics happened. This is the first candle, second, third, fourth, fifth, sixth, seventh, eighth candle you got. See, earlier we got, within 4 candles we got nearly 7,000 US dollars profit we got for the short trade. But long trade, to get 2,042 US dollars, it took 8 trading sessions. This is what market dynamics you must understand. Theory is different, practicals are different. Identifying what is happening in the market on the charts is different. What is Others are giving recommendations are different. That's why I always discourage giving the recommendations. I always encourage you should learn the subject. Because you learned the subject, you identified this change. Because of this change, immediately you changed your analysis. What you changed? Instead of this target, you changed the target to the new target. Maybe a small profit, fine. But still you got, instead of getting 1,928 US dollars loss, you got 2,042 US dollars profit you got. Why? Because you learned the subject. You are an expert by learning this subject. By learning this subject, what is happening dynamically in the market, you are observing. That's why immediately you changed the analysis and revised your target. But those who get the recommendations won't happen like this. They're only giving you what is entry, what is stop loss, what is target, that's it. Until it reaches the target, you will wait. Or if something happened in the middle and analysis changed or new profits are getting, you won't be knowing about that. And finally, you book the loss. Instead of getting $2,000 profit, you got $1,928 loss you got. Who is better? Person who is having knowledge is the better person, or person who is taking the recommendations is the better here. That's why I always encourage learn the subject. It's a very, very important analysis. That's why risk reward calculations, observing dynamically what is happening in the market, they are all very, very important. Many beginners will ignore them. Okay, so this is what the analysis we did for Bitcoin. Okay, next let us look into. Now I will be focusing only on drawing the zones using type 1, type 2, type 3 because I gave you a very detailed example. Just want to tell you, same thing is happening in the other markets also. See here we have a drop base rally. See, this is the demand zone. Which one? This is a type 1 proximal entry. First of all, how we drawn the distal line? Distal line rule, what is the rule? The drop candle, base candle and rally candle. That means leg in, base candle, leg out candle. Among three, which one is having the lowest? Because this is the drop candle. Lowest is having leg in because it is a drop. So that is our distal line. This is a type 1 proximal. What is type 1? The highest wick of the base candles. Did you get the entry? Yes. After that, see how prices were moving up. Suppose you would have took this type 2 proximal. See, risk is reduced. Did you get the trade? No. We might have missed the trade. Type 3, even risk is reduced. First of all, type 2 trade itself is not executed. How can we get type 3 trade? Impossible. That's why type 1 is always safest. We got the trade and immediately it moved. Huge move. And those who took for type 2 trades, they might have missed this entire big move in gold. See, the advantage, risk is reduced, but disadvantage, you miss the entry. Price did not reach. Of course, type 2 is ideal scenario. No arguments on this. But I'm trying to tell you, sometimes if you don't plan type 1, you may miss the trades. Okay, to overcome this problem in the phase 2 training, you will be learning other techniques for identifying the entry, stop loss and all. At the time, you will be learning another advanced techniques you will be learning. A concept called zone confluence. In lesson 16, I will be teaching that concept. But until then, focus on this. Next, silver. Look into the silver. We have drawn recently this rally, base, rally. Rally, base, rally. Only the lowest wick of base candle or leg out is the distal line. you won't be considering rally candle, you won't be considering leg in candle for the distal line. Only base and leg out. So base candle is having lowest. So let me draw. See, it gave an entry and after that again silver is also started flying. So this is a type 1 proximal. Okay, ideal scenario type 2. Let me draw type 2. This is a type 2. Type 1 is highest wick of the base candles and the type 2 is highest body of the base candle. See the body. Even type 2 proximal also it got the trade. So whether type 1 or type 2 we would have got the trade. No issues at all. Imagine type 3. What is type 3? Lowest body of the base candle. We have only one base candle. This is the lowest body. If risk is definitely reduced here, no doubt in that, but we would have missed the trade. If it is type 3 in silver, you would have missed the trade. And this entire big move, you might have missed it. Hope you understand the difference between type 1, type 2, type 3 and also advantages and disadvantages of type 1 and type 2 and type 3. This is the maximum risk. With the type 2, risk is somewhat reduced. With the type 3, maximum risk we reduced, but we did not get the trade. Type 2, somewhat risk is reduced. You got the trade. Definitely you would have captured this big profit. Okay. And look into the crude oil. This is the crude oil chart. See here you have a rally, 3 base candles and a rally candle. The highest wick. So this is the highest wick of the base candle and this is the lowest wick of the base candles. And a leg out base candles, lowest wick. Rally candle, leg in candle you won't consider for identifying the distal line. Only you will be using base candles and leg out candle for identifying the distal line. That is the lowest wick of base candles and leg out candle. So this base candle is having lowest wick. We are not considering leg in. This is the rule. See here, if you would have planned type 1 proximal, this is the risk. If you would have planned type 2 proximal is the ideal scenario. See, risk is reduced. Actually, it is slightly stopped out. That means your trade. Later on, you will be learning a concept called stop buffers in lesson 18 or 19. At the time, not exactly distal line, a little below distal line, some rules are there. As per that, you will keep some stop buffer. That way your trade would have been saved. But as per the concepts you learned, as of now, distal line is your stop loss. Maybe your trade is stopped out here. See, if you would have used type 1, see how much loss you would have got. This much loss you would have got. Wick to wick. If it is a type 2 proximal, you see, now risk is reduced. If it is type 3 proximal, see, the lowest body of all these base candles. See, your risk is very small. But many times you will be missing the trade. That is the problem. That's why ideal scenario is highest wick of these base candles for the demand zone. You got it? See, this is a failed scenario. And risk is at ideal. It is not very high or not very low. In between. So this is the advantage of going for type 2 proximal entry. Now let's look into another example, euro and US dollars. See here you have a rally candle, you have 2 base candles, you have a rally candle. Now if you would have drawn a zone like this, rally, 2 base candles and rally. So that means leg in, base, leg out. Because it is a rally candle, among the base, leg in is the rally, among the base candles and leg out candle, whichever the one is having lowest wick, that will be the distal line. Here base candle, the second base candle is having lowest wick. That's why we have drawn the distal line here. And here highest wick, wick to wick I have drawn. Okay, what is the ideal scenario? Type 2 proximal. This is the type 2, highest. A small risk is reduced. If it is type 3, you would have taken this trade. See, all the trades you would have missed. None of the trades came to the zone. This one came somewhat close, but narrowly you might have missed. See, if it is type 2 proximal, see, you would have captured this first trade, you would have captured this second trade, you would have captured this third trade. And this could have been your supply zone, target zone. Actually, wick to wick. This is the supply zone. Suppose if you are planning a short trade, type 2 proximal you will plan. See, this is the type 2. Here this trade would have been executed and you would have got the profit. And this is the risk. And from here to here is the reward. Here you would have got and reward. Similarly, if you would have taken a trade here, maybe on the same day, market opened, it gave you a trade, and after that prices were moving. Same day it reached the target and gave you this entire profit. See, for this demand zone, this is the risk. For supply zone, this is the risk. Here you would have got a first long trade. Here you would have got second long trade. Here you would have got third long trade. Similarly, here you would have got the first short trade, and here you would have got the second short trade. Now prices are moving here. There are two possibilities: either this may be violated, or again somewhere here it will push the market down. Anything may happen. But only thing is, risk we minimized here by taking type 2 proximal entry. If type 1 proximal, see how much risk for this zone. Huge risk. Now because of type 2, our risk is minimized. This is the importance of type 1, type 2, type 3 proximal entries. Depending on the risk. If risk is huge, you can't take type 1. You have to reduce to type 2. If type 2 also risk is very high, if you feel, go to type 2. Maybe you may miss the trades. But sometimes if any trade you got, luckily, probably if the trade is successful, with small risk you get big profit. In case if the analysis fails, because your risk is small, even if you lose small amount, it won't hurt your overall capital. That is the main advantage of risk management. Next, look into Great Britain US dollars and pound and US dollars. Here you have a supply zone. See here. This is a large candle as a leg in. You have a supply zone here. This is a type 1 proximal. If you would have gone to type 2 proximal, see your risk is minimized. See, you would have got a very good successful profit here. Here also you would have got a decent profit up to this rally base rally. And one more trade probably today you would have got. Maybe it can be successful if it goes, maybe it might be violated. Even if it violates, your loss will be very minimal. Why loss is very minimal? Because you took it to type 2 proximal. You may ask a question. Suppose if I would have taken type 3 proximal. Type 3 proximal, maybe first trade you might have missed narrowly. This huge profit you would have missed it. But second trade, yes. Your risk is minimized and reward is also improved now. You would have got some decent profit. Minimum 1:3 RR you would have achieved. When you have to go to type 3 proximal trades, suppose if you are not getting 1:3 RR in type 2 proximal entry, if you don't go, you can try for 1:3. If suppose that gives 1:3 RR, you can plan a trade. If type 3 is also not giving 1:3 RR, better you reject the trade because the risk is high. These are the techniques. Anyway, you will understand all these risk management techniques more effectively in the upcoming lessons. You will understand. But understanding risk management at this stage is very, very important. Generally, people teach at the end of the course. No. Actually, beginning of the course itself, you should learn risk management. If you understand its importance, then you will be a better trader. Look into US dollars and Japanese yen. Here you have a drop candle, you have two base candles, and you have a rally and follow through candles. If you would have drawn a zone, maybe here you see rally, three base candles and rally. Maybe from here only it picked up. So this is the best zone. Rally, three base candles and a rally. Let me draw a demand zone here. Demand zone, green color. So this is the demand zone. This is a type 1 proximal. See, risk is very high. Now go to type 2 proximal. See here. How risk is reduced now? You would have got a very good, even type 3 you would have drawn. Still you would have got a trade. See, risk is very, very minimal. Still you would have got a trade in this candle. After that, how prices moved up, huge profit you would have got. But all these other trades you would have missed. Type 3 proximal. Only one trade you would have got. Because you are going for type 2 proximal. This is the first trade you would have got. This is the second trade you would have got. This is the third trade you would have got. And today fourth trade. Maybe prices again will go up, or maybe if it is violated, this is the loss you will get. Because you know how much loss you are going to get before taking the trade itself, you are aware. How? Because we are calculating between entry and stop loss. Distal line is stop loss. And no other system will tell you what is the loss you are going to get before planning the trade itself. This is the beauty of supply-demand zone. This much loss you can't bear. Either you reject the trade or you will be looking for type 3 proximal. You have that option. Because this risk is very, very minimal. Now you can handle this risk. Only you plan trade, only prices reaches here. Luckily price reached here in this candle. You would have got a very good profit. Suppose if your analysis went wrong, your loss would have been a very small loss here. This is how you will be managing your trades with the type 1 proximal, type 2 proximal and type 3 proximal. Let us look into NeoStock. See here NeoStock you have a rally candle, you have 1, 2, 3, 4 base candles, you have a drop candle, you have a supply zone. And here you would have drawn a supply zone here. See, it gave you a trade. If the risk is high, you would have planned for type 2 proximal. See, this is type 2 proximal. Your risk is reduced. Not only risk, your reward is also improved. See here, you would have got this much profit. This is the risk and this is the reward. So this is the way you can apply the supply-demand zone concepts and manage the risk by using type 1, type 2 and type 3 proximal lines. And distal line you will be drawing as per the rules you learned for rally base rally or rally base drop base rally for demand zones. The rules are different. Similarly, supply zones, the distal line rules are different from drop based drop and rally based drop. And whatever you learn all these rules, accordingly you plan your trades. And accordingly you draw the zones and then plan the trades based on the risk management. And the minimum risk for all the new members should be 1:3 or risk you should maintain. That is the safest approach. You may ask a question, what is the advantage with 1:3? Suppose you took total 4 trades, 3 failed, 1 successful, still you will be in break even. That is the advantage you get. That is the beauty of supply demand zone concepts. Even 3 failures and only 1 success with 1:3 RR. You are in break even. Which system will be providing such kind of capability? Suppose 50-50 chances, 2 successful, 2 failed, still you will be in good profit. 2 times profits you will be getting. Strictly speaking, 6 times profit compared to the risk. So these are the advantages you should understand. Supply demand zone, always it protects our capital by minimizing the risk. Supply demand zone always tells you before taking the trade, this is the loss you are going to get in case if your analysis fails. That is what it is telling before taking the trade itself. If you don't accept that much loss, you don't take the trade. Simple, you reject. Hope you all understood the importance of this risk management. So let's all meet again in our next video. Thank you.